Welcome on board Ashwini Agarwal. He's founder at Demeter Advisors. Thank you so much for taking time out. Wanted to start off by just getting your take on the market because it seems that there's been one direction only for us for quite some time. And despite the fact that earnings momentum is slowing down, the FII selling has been relentless. It's pretty much a 1 to 2% fall a day after day at max. Are we in store for a bigger correction, and when is that due?
Hi, good morning. Thanks for having me here, and thank you for the direct question. This is something that all of us old timers have been struggling with because valuations have been stretched for quite a bit. And when I've spoken to your channel before, I've said that things look a little bit stretched, and the market continued to kind of move up. Even the correction, as you say, over the last couple of weeks has been kind of tepid. It's not anything significant. Though I think the supply of paper and the relentless FI selling is taking its toll at the margin. So how do we look at things from here? I think, if I zoom out, I think the earnings season's turning out to be a little bit soft. I think the economy has slowed down. Now, let's see how the festival sales do and if there's a sort of sharp uptick in the economy once again, which, as per the RBI, had slowed down because of unseasonal rains and excessive rains. But I don't know if that will happen or not. And I think the valuations are continuing to be challenging in many pockets. So I don't think that there is a lot of room for the market to move up. Now, how much will it fall is something that I'm not very clear about because every fall has been rewarded for buyers, and I think that lesson has gone down very well. So, any dip, you see a massive amount of buying coming in. Obviously, this time around, things are a little different because there's also a lot of supply of paper, both primary as well as secondary, which is happening. So that might actually kind of neutralize the inflows that we are seeing. But I don't want to underestimate the power of the local investor. So it's difficult to say how much it will go down, but I don't feel very good at this point.
This slowdown which has hit the market, is it something which is already factored in, or it will keep on disappointing us? Because the stock reaction by companies where disappointment is there, whether it's Bajaj Auto or Reliance, I mean, any company which is disappointed has been taken to cleaners. So can I say that a lot of this bad news is already getting factored in?
Nikunj, probably individual stock wise, but I don't know whether the broader slowdown, let's say, GDP growth, for example, RBI's forecast is 7%, if I'm not mistaken. If we read what is being written by other economists who are tracking this number, they're closer to 6.5%. Now, the trend is what matters. The trend is negative right now. The nominal growth of revenue, if you just look at whatever quarterly numbers have come out, is nothing exciting. Even the GST collections are a little bit soft, just in line with nominal GDP growth. So, all of this is telling us that there is that push to growth is missing. Now, whether it is because elections caused a temporary slowdown in government spending and private capex hasn't really picked up even today, whether it is the external sector which continues to be kind of soft from a demand conditions point of view in most parts of the world, barring the US. It's very difficult to say, but I think a lot of things are coming together. So I would say that there is a high likelihood of disappointments gathering steam from here. So, the momentum of negative news kind of builds up is how I think about it.
What could be the out of jail card for us? Could it be reversal in China? Could it be FIs coming back? Could it be pure demand from festival season? What could be the out of jail card? I'm using this out of world jail card often. I mean, just started playing Monopoly with my son. So you remember that out of jail card?
Yes.
So what is out of jail card for the bulls?
Let's say the rest of the earnings season is blockbuster, and all the large caps are probably sort of out of line with what's happening to the underlying economy. I mean, if the rest of the results season is very, very strong and everybody kind of shows up with numbers that are rock solid, then of course we'll be wrong. Then I don't think the current support levels will break, and you might, who knows, see new highs. I think the other one, okay, on a more serious note, if I think about the global perspective, I think there's been a very confused outlook on interest rates. If you just look at the US 10-year bond yield, it went down to 3.9. Now, yesterday it was 4.15. There is a note from one of the leading portfolio managers in the United States on the fixed income side saying that they expect the 10-year bond yields to touch 5%. I don't know whether it will happen or not, but I mean, that's a pretty scary phenomena. I think a get out of jail card could be a softening of interest rates globally and RBI following suit. And I think if that comes through, that might actually allow us to muddle through this soft patch of earnings. But on the on and the softer interest rate environment in the US will also allow the Chinese policymakers to continue to pump prime the economy. So I think that is the real out of jail card if it comes to pass.
So what should be the best portfolio strategy? Like sit on 15-20% cash or more, or don't try to be cheeky in this kind of a market, because if the 3-year picture is better, then there is no point in trying to time the market, get into this emotional trap and pay extra brokerage and extra tax.
So, Nikunj, a great question. And I was laughing at your question because I've been sitting on 15-20% cash for a while, and it's been really painful. And I think what you say is right. I think the way to invest in the market for people who are individual stock pickers among your viewers is to build solid conviction about what you own on a 3-year basis and be prepared to say, okay, if I see a 30% drawdown in the stock price, I'm not going to panic, and I'm not going to get phased, and I will continue to hold if the 3-year outlook is something that I believe in. And that conviction is the only thing that can see you through. For mutual fund investors and people who do SIPs, I think it's a foregone conclusion. The last 20 years have taught that timing the market is fruitless. So you might as well continue doing what you're doing. You might see a 15 or 18%, in the very worst case, drawdown. More likely it will be single digits, high single digits or early teens, but 3 years from now you'll be much higher from here. So why bother? Just continue to stay the course, and like you say, timing the market doesn't pay, and then it involves costs including brokerage and taxes. So why do it? So I think it's a combination of both. I also think that there are pockets of exuberance. So let's go back to September 2021. September 21 to March 23, we saw a 15-17% correction in Nifty, somewhere of that order. But there were stocks that were down 80%. And the stocks that were down 80% were the ones that were the most celebrated IPOs of that year, where valuations are completely nuts. Similar to that, we've seen a big correction in defense names in the last, 3-4 months. We are seeing corrections elsewhere. So I think individual valuations is something which does merit a deeper look. If you own something which has completely bizarre valuations and earnings are not reflecting, what your expectations are, then you are better off without them. Because the correction, if it happens, is going to be very painful for the stocks that are expensive.
That it sure would be. So, Ashwini, I'm quite curious. Yes, you can't time the market. No one can, other than God, perhaps. But tell me, what is it that's going to make you deploy that cash that you're sitting on? And more importantly, what's the shopping list looking like? I'm sure you've already done your homework.
So, there are a bunch of things. So financials, they've been complete underperformers in the last 2 years, 3 years. So some of them are looking quite interesting at this point in time. So, that could be a place where you could deploy some money to. The only caveat I would add is that a lot of the financials face disruption risks and regulatory risks. So when you do your bottom-up stock picking, please bear in mind these two risks. And I think the larger, well-funded, compliant players are probably where you want to be. So that's number one. Number two, I think export-led, especially chemicals, certain other commodities, textiles, garments. I mean, that's the other broad brush area where I would say that I'm quite constructive, because I think a lot of the demand has moved to India. And I think some of this will continue to drive earnings for the next 2, 3, 4 years. So, those are the two places where I can say at least sectorally, I feel favorably disposed, and pharmaceuticals would probably be the third one. Otherwise, across the board, when you look at it from a sectoral perspective, there's not really much that you can pick and choose. Everything's pretty expensive. If you broadly speak about sectoral biases. But I think on a bottom-up basis, there are ideas. And like I said, in the initial phase, either sit on cash or stay with the large caps. And as the correction deepens, if it deepens, deploy the cash and buy, medium-term growth stories. I mean, that's how I would go.
Thank you for joining in. Good to have you on board with your thoughts on the markets. But yeah.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.